morning. Welcome to the investment meeting of the Teachers Retirement Board for April 16th, 2026. I'll start by calling the roll. Thomas Brown.
Present. Good morning, Patricia.
Morning. Phil Dukes. Gregory Faulkner. Amy Smiley.
Present, and good morning.
Good morning. Victoria Lee.
Present. Good morning.
Good morning. Christina McGrath.
Good morning, Patricia. Present.
Good morning. We have a quorum, and I'll turn it over to the chair.
Good morning, everybody. Welcome to TRS's investment meeting. I let the record show that Anthony Giordano is present as well. And before we begin, let me extend congratulations to Monty Tarlox for his appointment for CIO. Welcome.
Thank you, Mr. Chair. Appreciate it. I'm glad to be here. Glad to be able to dig in a little more and assist the fund over the course of the long haul now, rather than just temporarily.
Thank you. And welcome. Pleasure having you back. So we start the meeting today with the public agenda passport funds, February passport funds flash report. And we'll think Amanda's going to do that from BSM. Thank you.
Can I just,
Sure.
Nadia is here from the
With mayor's office.
mayor's office.
Welcome.
Sorry for the interruption.
No problem. So Amanda, we'll start. Thank you so much.
All good to go, Tom?
Yeah, thank you.
Okay, so I'm gonna start out with the results of the passport funds through the end of February. And just to kind of orient us, there's a lot that's happened over the last month or two. If you'll recall, the conflict with Iran began on February 28th. So really the month of February here is not reflective of a lot of that, although certainly some of the tensions with Iran were building during the month of February. But overall, I would say returns across the passport funds were mixed, modestly positive for certainly the diversified equity fund, which is a mix of US and non-US equities, the non-US equities being the main driver of returns during the month of February, similar to the results we saw across markets in January as well. With active management being a little bit of a drag and US equities being slightly negative, 50 basis points to 1% down for the month. The strongest performing option in the passport funds for February was the International Equity Index Fund at the bottom of the page, up over 5% for the month. So looking at the year-to-date column, which is reflective here of both January and February results, positive across the board for each of the passport funds. The Diversified Equity Fund up 3%, and on the high end, the International Equity Index Fund at the bottom of the page up 11% year-to-date through February, building on strong results from the month of January. Unfortunately, as you'll see in a minute here, as I flip over to March, a lot of that changed with the beginning of the conflict. Try that. Apologies, it's not letting me flip over to my. Sorry, technical troubles here. Give me 1 second. Okay. Reshare. Okay, sorry for the delay there. All right, so starting obviously with the weekend leading into the first business day of March, we saw attacks in Iran from the US and Israel. The key impact here has been to the Strait of Hormuz, which has had implications for both supply of oil and impacts to energy infrastructure. So you saw a spike in energy prices that also raised concerns around the expectations for economic growth globally, as we've seen an increase in expected inflation and also a slowdown in economic growth. So we did see a sell-off in equities globally, particularly in international markets, which, as I mentioned, had been the strongest performer for both January and February. So looking down the column here at the month of March, essentially the losses in March erased the gains from both January and February. The proxy benchmark here for the diversified equity fund being down 6.3% for the month of March. And down at the bottom of the page, looking at just the international equity passive index there, down close to 11 for the month of March. And so that puts us, if you were to look at the calendar year to date column, which is capturing the first quarter of the year, at essentially in negative territory across each of the options. Really the one positive return for the quarter has been the short-term fixed income component of the balanced fund. So things have continued to be volatile. We've seen a reversal of this again here so far in April. So that volatility continues, but the market sentiment has continued to shift in line with the news cycle. And so far, markets have reacted very positively to the temporary ceasefire that is currently in effect, and more to come there. But the S&P 500 did reach a new high just as of yesterday. So we've seen a lot of return to positive sentiment for the equity markets so far here in April.
Thank you.
Any questions?
Questions for Amanda? Great. So we move on to the public agenda pension fund performance update. That's Dan Haas. Good morning, everyone. Thanks again for having me. We'll jump right in. Familiar slides, of course, and do it for these non-quarter month ends. We ran these as of Monday, and I'll just take you through, take you around the hoops here. GDP on the top left there. Fourth quarter, again, it may seem like ancient history now, but there is still a story to be told here. The headline number for the U.S. Came in significantly weaker than the third quarter, and was actually revised down twice from their initial estimates. The BEA, the Bureau of Economic Analysis, it reports each quarter's numbers 3 times. They initially came in at 2.8%. That initial was cut in half to 1.4%, and the final print came in at 0.7. Oh, it looks like 0.5 now. That's interesting. Pardon me. Yeah, sorry, that was a misprint. At any rate, the third quarter was 4.4%. Again, significant weakness in U.S. GDP growth. That was led by declines in net exports. There's a trade lag despite the weaker dollar. Government consumption also was driven by the government shutdown that dragged GDP in the fourth quarter as well. And then we saw personal consumption was off a bit as well. If we go down to inflation, the CPI, that came in last Friday at 3.3%, which was up from February's 2.4%. Again, this was driven largely by energy pricing as a result of the invasion of Iran. Bad news is, it's not a great number. It's the largest monthly increase since 2022, and the highest we've seen over the past 2 years or so. The good news is it's not as bad as we thought it would be. The consensus estimate for the quarter, for March was 3.4%.
So it came in a little bit lower than expectations. The core CPI, which strips out food and energy prices, was 2.6%. And again, that came in a little bit below expectations of 2.7% for March. We move over to the top right, looking at our unemployment numbers, or rather our employment numbers. Unemployment came in 4.3%, as you can see, modestly down from February's 4.4. The jobs report in March was a positive surprise. If you look at the payrolls line there, the consensus estimate was 65,000 new jobs created. We actually saw 178,000 as opposed to that. It's a kind of reverses February's negative surprise. February, the number was hampered by way of reminder, a kind of healthcare strike, and there were some weather disruptions. Those unwound in March, and then we saw job growth in healthcare, construction, transportation, and leisure hospitality for March, which contributed to that robust number. As we move into the world currency there, again, not much to add to that story. Other than there's continued volatility, the dollar has been weak and is significantly weaker over time relative to those major currencies, particularly over the 1-year horizon. Japan has a sort of a special story. They've got their own kind of macro story unfolding there, which caused a bit of disruption. But you can see there's a lot of directional stability in the dollar weakening relative to these currencies. If we move on to the next page there, looking at the rates. As you know, Kevin Warsh, that's nominated. Senate hearings begin next week. We can expect to hear questions about how his traditionally, by way of reminder, he's viewed as an inflation hawk. He recently made comments, though, about how AI may provide a path to productivity or gains in efficiency, which could provide a path to a more accommodative fee rate, right? So again, underlying kind of Monty's comments from before, there's some uncertainty as to where he'll fall in terms of policy. He has deep ties to Wall Street, which again makes him viewed as a very qualified candidate. But you do wonder, again, pointing Monty's phrase, which Kevin Warsh will show up. If we think of look at the most recent Fed meeting, as expected, the March meeting, Fed held rates steady during that meeting. So the target rate remains at 3.75%. Inflationary concerns are increasing, so that the outlook for 2026 went from a consensus to 25 basis point interest rate cuts to 1, or perhaps, but it's looking like 1. Down below, yield curve again remains healthy. We still see that 52 basis point spread between the 2-year and 10-year yields. We're receiving carry, but again, underlying the same story we've been saying for the last few months, where that is a normally sloped and good news curve to showing normal market function. Spreads, same story. That's the top right there. They remain near their tights. They have broadened slightly over the past month or so, but they're still near their long-term tights for both investment grade and high yield. And then finally, I'll just bring attention to the mortgage rates there. Again, it's 6.48% as of the 13th on Monday. That is up slightly from the lows, about 35 basis points from the lows that we saw in February. Again, that's sort of a reflexive of the Fed's higher for longer rate regime that's being priced into those assets. Historically, we like to see those closer to 5.5%, but it's a little bit of volatility there. Hopefully, on the downward trend eventually. Any questions on this material? We'll move on. Questions for Dan? Great.
Thank you, Dan. So we're up to now the 2025 annual climate report. And Nina Chen.
So are we moving to executive or?
I have that in public.
I'm sorry. I was
Agenda. Thank you, Nina.
So should we go to the podium?
Yeah, sure. That'd be great. Thank you.
Good morning, everyone. My name is Nina Chen. I'm the Senior County Finance Officer. I joined about 7 months ago, and my job is to implement your net zero plan. So I'm going to bring up the presentation. Today, the ESG office, the team is going to present. All right, there we go. Present the annual climate report of 2025. And this is the third time that we are presenting this.
Can you hear? Hello. All right, that's better. Yeah, so this is the third time we're presenting this since the net zero plan was adopted in 2023. So now I'll pass it to my colleague Neha Naim. You can follow.
Good morning, everyone. I'm Neha Naim. I'm the ESG Strategy Officer, working closely with all the members of the ESG team. I'll walk us through the climate metrics portion of our climate report, and then my colleagues will follow up with the engagement portions of the report. So the first section here is emissions disclosure. Just to remind ourselves of the context, in 2023, teachers had set a portfolio-wide goal for its public portfolio only to reduce the carbon footprint, also measured as a finance emissions intensity for scopes 1 and 2 emissions of its public equity and corporate bonds by 32% by June 2025, using a baseline of December 2019. The good news is, or rather the old good news is, that teachers had achieved this target last year in 2024 and has continued to decrease the carbon footprint as of fiscal year June 2025. The total emission reduction as of June 2025 stands at 49% against a target of 32%. It is worth noting that these interim targets were set only for public markets, and that too for scopes 1 and 2 only. Teachers did commit to set scope 3 targets this year as of June 2025. However, as it stands, we don't feel comfortable with the quality of scope 3 data and are not comfortable with setting the targets yet. This puts us in a similar position as other major asset owners who are also evaluating the quality of scope 3 data and have not set scope 3 emission targets yet. We are, however, disclosing scope 3 financed emissions in the report based on the information that we get from MSCI. We are also in the process of procuring private markets emissions data, and some of which will be included in next year's climate report. Here's a visual representation of how teachers' carbon footprint has fared across the last couple of years. And as you can see, we have observed a much greater reduction in the emissions compared to the target set for June 2025. We want to emphasize that just as the past performance has not been straightforward, we do not expect future changes to be linear. But we bear in mind that teachers has the next target set for June 2030, still using a baseline of December 2019, and that target stands at 59%. Now, in the report, we do a detailed attribution analysis to understand the different drivers of this change in emissions over the years. To summarize, the fossil fuel reserve owners' divestment remains the single biggest driver, but other factors also helped here. These include the overall public company emissions decreasing, particularly in the developed economies, along with the increase in the enterprise value of the public companies that also helped sort of decrease the way we calculate this equation. Portfolio changes also help this change, which includes the business as usual trading in the active portions of the portfolio. So overall, these factors combined have pushed the carbon footprint down for teachers' portfolio. Is there any questions here?
Okay, so this has been an issue of discussion for many years. And at some point, it was, I think, 286 names that we were divesting from with a swap of about 100 names per year. What is the overall BAM approach now? I think we had different consultants advising us at that time on divestment. So what's our overall, what is the overall approach? How many names are we divesting from? What is the swap? I haven't seen that report actually probably in a year or so.
Right. So divestment was a one-time thing, and that happened a couple of years ago.
Well, it seemed like more than a one-time thing.
Yes, it was a one-time.
The names.
So in the future, we are not expecting any more divestment. We are expecting engagement to be the approach to sort of engage the high emitting companies and sort of direct them into reducing the carbon footprint.
Yeah, sorry, Cristiano. So I'm running the investment screen. So
Thanks, Mr. Rankin. Speak up.
oh, sure, the people are on. Could hear you as well. Thank you.
Thanks, Neha. And forgive me, the screen itself, as Neha mentioned, was a one-time divestment. The criteria was set by BlackRock, pardon me, at the time, and they've since no longer engaged with that. So, like any other screen, we run an update on an annual basis. We're still finishing that up actually at BAM right now, and you'll see that probably in June, somewhere in that context. Specifically to the fossil fuel divestment, though, we're exploring new ways of updating the screen itself. So for now, your list is being carried forward year on year. That was a large number of constituents on the list, and it's because at the time we asked BlackRock to identify every security issued by a company that fell on that list. So it was this huge 487 constituent list. When you look at it on the issuer level, it comes down to closer to 200 or somewhere in the 200 range. Right now, we're working with the teams at Teachers and with Goldman. And one component that's unique to Teachers' approach that you don't see from the other two systems that have divested from fossil fuels is that there's some recognition of transition scoring. Right. That's a tool set that we hadn't incorporated into the other one. So right now we're in the evaluation stage to understand how transition scoring kind of fits into a screen tailored for your investments.
So Dan, that's very interesting. I would be reluctant to talk further about possible prospective changes in any screening we might be doing in public session.
Fair enough. Yeah, thanks.
Can I just ask a general, I know what transitions are, but in this context, what transitions is the potential of the company to changing their data changes and might put them in a divestment situation.
Yeah, I mean, it's
in generality.
Yeah, it's still a bit up in the air, but the idea is that a company's readiness to reduce carbon emissions or adopt new business practices toward that end. Again, bit early stages right now, but we'll certainly have a good.
But we don't anticipate large changes as we had seen.
I wouldn't think so. Yeah.
Okay, thank you very much.
Sure.
Any other question?
Okay.
All right. But in that case, I will move to the next section, which is the update on our climate solutions investments. Just to remind ourselves of the context, Teachers had set an interim goal of taking its climate solutions investments across the total portfolio to $4.2 billion by 2025. There's also a 2035 goal for Teachers, which stands at $19 billion for climate solutions investments. While Teachers invested in some climate-focused funds across asset classes, the majority of the climate NAV comes from outside of these climate funds. And I'll get to the good news here. And again, the old good news that Teachers achieved its 2025 target last year in 2024 and has continued to increase climate exposure in fiscal year 2025. As of June 2025, total climate exposure stands at $7.3 billion. Now, this slide shows the breakdown of climate investments across all asset classes in the Teachers portfolio. It's worth noting that passive public equity has an outsized contribution to the total climate solutions, and that is primarily driven by the big tech companies. We use MSCI's green revenue metric to measure climate solutions in public markets, and that assessment has led NVIDIA, Microsoft, and Amazon alone to combined represent 30% of total climate solutions for Teachers as of June 2025. We are working with MSCI to better understand this trend and are supporting MSCI in its consultation that has proposed changes to this definition. Any questions here? With this, I will wrap up the discussion on metrics and pass it on to Jamie Satter to talk about corporate engagement. Thank you.
Thank you.
Good morning, everyone. I'm Jamie Statter. I lead corporate engagement for the climate work. As you just heard from previous sections, the majority of our emissions reductions are from factors that aren't necessarily easily replicated, which means that future emissions reductions are largely dependent on engagement from both ourselves and other climate-focused investors. In public markets, you set a goal that 70% of your financed emissions would be covered by science-based targets, which are emission reduction targets that are aligned with the Paris Agreement. That goal was meant to be met by the end of last fiscal year. Our engagement work in the last several years has focused on this goal, and yet only 27% of TRS's financed emissions are covered by science-based targets as of the end of last fiscal year. This is inclusive of both the Science Based Target Initiative, which is the primary organization that validates targets, as well as new this year, the Green Steel Climate Council, which is an industry standard that we are comfortable recognizing and utilizing for the purpose of science-based targets. Science-based targets we're unlikely to see an increase in this figure, largely because SBTI is the primary organization, has undergone political attacks, and is also quite stringent and therefore not particularly suited for the highest emitting sectors, which are the sectors that we're looking to set these targets. So there is a need for us to look beyond targets, and beginning this year, we are going to be expanding our engagement work to better mirror the net zero investment framework, which assesses companies based on targets, but also a number of other factors that we believe are highly relevant, including decarbonization plans, CapEx, and transition plans. Another important area of this work is that we look at this from both a sectoral and systematic perspective. Primarily, in the last few years, we've focused on utilities, which consistently represent a large share of TRS's financed emissions. Last year, they were 27%. They also are a critical underpin of the rest of the economy's effort to decarbonize. So we've spent several years getting very deep on utilities with our other partners as well. They've consistently stated that they will not be using SBTI to set science-based targets. So we've sat on an advisory committee by an industry group for the last 2 years on an industry-led effort to create a target setting protocol. Unfortunately, after many, many hours of work, it's clear that this target setting protocol presents an unacceptable greenwashing risk. So we're unable to utilize that as well. The good news from this is that it has established TRS and BAM as a national leader on engagement with utilities. We coordinate with dozens of other investors and have direct relationships with all of the major utilities in this country, which will give dividends in the future in our ability to really engage on these critical topics. One of which I'm going to talk about next, which is data centers and AI. We have seen an enormous growth in data centers, which has presented a growth in emissions from some of the lower emitting companies who in the tech sector have seen their emissions go up by as much as 30%. We have been engaging both with utilities and the hyperscalers and will continue to do so on this issue. We see our role as a universal investor as particularly useful in this regard, in that we have stakes in both the utilities and the tech companies, and we're able to kind of bridge those gaps through engagement discussions. So we're in a very good position to represent your goals in this sense. And then finally, I will touch on the banks, which is a major area of focus. 3 years ago, we filed shareholder proposals at the largest North American banks asking that they disclose what's called an energy supply ratio. That's their ratio of green to brown investments. We see this as an important metric in understanding the bank's role in the pace and scale of the energy transition. In the first year of that proposals filing, we reached agreement with JP Morgan, Citigroup, and Royal Bank of Canada. Last year, JP Morgan and Citigroup disclosed their ESR for the first time, which is significant. Royal Bank of Canada calculated their ratio and disclosed their methodology, but did not disclose the ratio itself because of legitimate regulatory issues in Canada. One thing about RBC that's worth noting is that they have let us know that they are internally managing to this metric, which is a very significant development for something that we put forth in a shareholder proposal. It's improved the way that they're approaching this issue at a management level. So we're quite proud of that. We refiled the proposal this year at the 4 remaining largest North American banks. We withdrew at Morgan Stanley for procedural reasons, and I'm happy to report we reached a withdrawal agreement with Bank of America in the last few weeks for enhanced engagement. So this proposal will go to a vote at Wells Fargo and Goldman Sachs in the upcoming weeks. And that concludes the corporate engagement piece. And I'm going to turn it over to Jimmy next.
Thank you. Hi, I'm Jimmy Yan. I'm head of ESG integration. I'm going to talk about what we've been doing with your asset managers. Jamie is talking about engaging portfolio companies. We've also been doing a lot of engagement of your asset managers. So first, as part of the teacher's net zero implementation plan, you set expectations. Oh, sorry. Let me move the slides. Thanks. So you set expectations of asset managers to align as best as possible with your net zero goal, consistent with fiduciary duty. Specifically, your plan states that managers should have one of 3 things: a net zero goal, science-based targets, or acceptable alternative approach to support the transition to a net zero economy. You set a deadline for you set two different deadlines for public markets managers and private markets managers to meet these expectations. For public markets managers, the expectations apply to both new and existing managers beginning July 1st of last year. For private markets managers, the expectations apply only to new funds that are expected to close after June 30th of this year. To meet these expectations, BAM asks managers to submit a written plan describing their approach to decarbonization. The goal is real economy decarbonization, not just portfolio decarbonization. Therefore, as Neha mentioned, we're not seeking additional exclusions or divestments at this point, but rather engagement. We ask managers to systematically engage their portfolio companies and assets to advance decarbonization, but it's not one size fits all. The expectations differ based on asset class, strategy, sector, company size, and the level of control that the manager has over the company and investments. Ultimately, the approach has to be commercially reasonable and consistent with fiduciary duty. We have some outcomes from our engagement of public markets managers last year on these expectations. First, you have 42 total public markets managers that manage public equity and corporate bonds. All met the expectations except for 2, which are BlackRock and Fidelity, which is public information. In addition, 64% of the managers have net zero goals and or quantified targets to increase decarbonization. Quantified targets means that they simply have quantitative goals to reduce emissions or engage a portion of their portfolio companies to improve decarbonization. Also, 69% of public markets managers have created new practices directly as a result of your expectations. So that shows that your net zero goal has made a difference with managers to find prudent ways to address climate risk and opportunity. And finally, we'll be asking managers to report annually on their progress under these plans so we can see that they're doing what they say they're doing, and so we can assess their progress as well.
So that concludes the presentation. I'll open the floor for questions.
Thank you. Any questions? Thank you very much. Appreciate it. I think we're going to call down that for market commentary. Thank you. Thanks again. Welcome back.
You can see I was chomping a bit to get to this piece.
I know.
So, Donald, do you mind passing me a slide up? No, that last slide, performance update slide, executive. Oh, pardon me, yeah, I think we want to adjourn to executive.
The market commentary would be in the executive.
Market commentary is the public session piece, and then the performance update is all executive.
Okay.
Yeah.
So then.
That was fun.
So
So the first thing that he did was the market commentary for the public session.
was reversed.
Oh, I'm sorry. I didn't-
So you've done the market commentary and now
I'm
wants to
sorry.
do the,
Yeah. I have a different agenda here.
what's that thing?
No, it was reversed. I think I have an old,
Yeah.
Mine too.
Yeah.
You have the latest, we have.
Here's this one. It's the one on
Yours is the latest.
Yeah.
That we received.
then you need to do the, market commentary in executive session.
The performance update will be for executive session, because it's unaudited data.
I see.
Does Van have it? Sorry. Does Van have anything else for public session?
That's fine. Mark, do you have any manager updates?
I think can't we,
Manager updates will be in executive session.
right, I think we're ready to go to executive session.
Okay. Anything else for public session? Great, so do I hear a motion to go into executive session?
So moved.
It's been moved. Is there a second?
Second.
Any questions and comments? All those in favor going into executive session, please say aye.
Aye.
Or say nay. So we're now in executive session. Thank you. Sorry for that. Thank you. And I believe we're going to have a readout from Priscilla Bailey.
Hello, everyone.
Hello.
Thank you, Mr. Chair. In the executive session of the Passport Fund, there was a manager recommendation, consensus was reached. In the executive session of the Pension Fund, there was an update on preliminary performance. This was followed with a presentation on transition management service providers. Consensus was reached. The board also heard presentations on 2026 annual plans for public equity and public fixed income. Consensus was reached on these two asset classes. There were two manager recommendations. Consensus was reached on both. There was an alternative credit presentation. Consensus was reached. And finally, there was a private equity presentation. Consensus was reached. Details to be made public pending further action and at the appropriate time. Thank you.
Thank you, Priscilla. Appreciate it.
Thank you.
Any other business in public session? And I just realized I would like to thank in public session our Genesauer Tech and TRS and Will, our recorder in public session. Great. And with that, I'll entertain a motion to adjourn the meeting.
Second.
And is there a second?
Second.
Any questions, comments? Those who are in favor of adjourning, please say aye. Opposed, say nay. We are adjourned. Thank you, everybody. Much appreciated.